Okay, welcome, ladies and gentlemen, to MacroAce with your host, Tony. I'm also the head financial analyst at FinancialJuice. Yes, I haven't done a live stream in a while. I was off poorly, and then it was Eid yesterday. So hopefully you guys, whoever does celebrate Eid, hopefully had a lovely day. Did miss out on CPI though, which had a great reaction in the markets. That has been updated, of course, in the deviations and ranges Google Sheet. So you should be able to see the mega reaction that we had from CPI yesterday. But let's go through the ECB rate decision and how they have been affected, or how expectations and bets have been affected by the CPI report yesterday. But let's go through it. First of all, what are the two rates that we're going to be focusing on today, the refinancing and deposit rate? First of all, we have the refinancing rate, which determines the amount of credit institutions pay by the ECB when borrowing for 1 week. And then you have the deposit rate, which is the first is the interest rate paid by the ECB to banks for holding a deposit at the ECB. So where is the economy at the moment? So inflation heading closer to the ECB's target of 2% at 2.4% compared to 2.6%. Core CPI at 2.9% compared to 3.1%. Eurozone manufacturing PMI came in at 46.1 compared to 46.5. Services was stronger at 51.5 compared to 50.2. Consumer confidence was also slightly stronger at minus 14.9. German IFO Business Climate Index at 87.8 compared to 85.5. And the ZOO economic sentiment was also stronger at 31.7 compared to 19.9. Inflation in Germany at 2.2% compared to 2.5%, and the harmonized index for inflation from Germany at 2.3% compared to 2.7%. So overall, if we're looking at how inflation is progressing in the EU, it seems to be progressing quite well. Maybe not very strong disinflation, but it is edging towards that 2% goal. And then there are also aspects of ECB members and their views on how well they think the inflation fight is going. And we'll look through those comments from different ECB members. So the previous meeting on March 7th, the ECB had said that projections for inflation, excluding energy and food, have also been revised down and averaged 2.6% for 2024, 2.1% for 2025, and 2% for 2026. Staff revised down their growth projections for this year to 0.6%, with economic activity expected to remain subdued in the near term. And they expect the economy to pick up and grow at 1.5% in 2025, 1.6% in 2026, supported initially by consumption and later also by investment. So there wasn't really a lot to go off of from the ECB last time round. And the market reaction, if you're looking at the ranges and deviations sheet, the initial market reaction more or less kind of confirms that there wasn't that much to work off on from the ECB rate decision and the statement that was released then. But if we carry on to the ECB meeting minutes to get a better understanding of what was discussed and how members were feeling during that discussion and their thoughts on inflation, where the economy is going and so on. So members expressed increased confidence that inflation was on track to decline sustainably to the 2% inflation target in a timely manner. The case for considering rate cuts was strengthening. There was a consensus that the rate cut discussion was premature, and questions remained about the sustainability of disinflation. And the reason why I'll be talking about the US inflation print that we had yesterday is because it also had an effect on the pricing of what markets expect the ECB to do. So ECB member views then. ECB's Casimir said that the ECB on March 11th, he said that the ECB should wait until June with their first rate cut. Rushing a move is not smart or beneficial, and discussions on easing should already start, and the ECB will use the weeks ahead for that. Then you had ECB's Holzman said that ECB on March 12th that ECB rate cut is more likely in June than in April, and cutting before the Fed is not without risk. Villeroy said that the ECB can cut rates independent of the Fed policy, and then later on, or the day after that, said that the ECB is more likely to cut rates in June than in April. ECB Storneras said that we have to cut rates twice before the summer break. Off of the back of that, the euro had weakened from that comment there from ECB Storneras. He also added that I don't buy the argument that the ECB the ECB can't cut before the Federal Reserve. ECB's Lane says we think wages are moving in the correct direction. ECB's not then went on to say that I expect the ECB's first cut, a rate cut in June. Further rate cuts this year are most likely in September and December. And then ECB's President Lagarde on March 20th said that even after the first rate cut, we can't pre-commit to the rate path. And in the coming months, we expect to have two important pieces of evidence that could raise our confidence level sufficiently for a first policy move. And then finally, from ECB's Nagel, he said that a June cut has a higher probability than April. So if it's not clear already, April is out of the question. June is what has been cemented as the first rate cut by what is cemented as a first rate cut by not only the markets, but has been given a very strong hint by the ECB members from the board themselves. Now, for a surprise in April, if they decided to deliver their first rate cut in April, that surprise, of course, would go against what is currently priced in. And when the unexpected happens, that's when a lot of volatility creeps in, and you see a panic within the markets and strong moves that occur. Similar to the US CPI data, which had the third increase in inflation, or third set of data that was stronger than expected. That surprise was enough to cement the September rate cut, and then also for the markets to see a rate cut being skipped in November and then another one being done in December. So a total of 2 rate cuts were seen by US markets after the CPI data. So surprises like surprises from the ECB, if they do decide to deliver a rate cut today, from what we've seen in the past when surprises have been delivered through data or through rate statements or from the rate itself, that causes a lot of volatility. But of course, with central bank rate decisions, you're not just relying on one figure and then that's it. You've made your choice. You're also reliant on the rate statement itself, and any other points that support it or that are provided with it. Because if the rate, let's say, is cut today, for both the rates, they usually don't do one rate; they do all 3 rates together. But they provide a hawkish statement with the rate decision. Then that would temper the bearish reaction that the euro could face from a surprise rate cut, and may mean that the path ahead for the ECB is more complicated and not as simple as we may have thought. Let's carry on then. So ING, so this is quite interesting. It's very useful to have a look at what they provide for their ECB crib sheet, is what they call it. The different scenarios of what could be presented by the ECB. So we have the current stance here that they say inflation is expected to decline gradually. On growth outlook, they expect economic activity weak in coming months, but should pick up over time. Being data dependent in their approach to future rate decisions. The PEP stuff, that's going to be important later in future meetings, not at this meeting. The key thing is, does the ECB become dovish and actually cut their rates today by 25 basis points? And to support that, if they say that they're sufficiently confident that inflation target will be met. So these are the 2 points you're looking out for. The key point here for the dovish scenario, for a bearish reaction from the euro, they feel that they're sufficiently confident that inflation target will be met. And if they deliver a 25 basis point cut today, then you're really going to get some good downside movement from the euro. But the base case scenario is they see them being moderately, they see them being moderately dovish. So on the inflation outlook, increasingly confident that inflation target will be met, but there is no rate cut, and more or less cementing the June rate cut. That would still provide some downside movement to the euro, but it won't be as big as a dovish scenario from what we see in that row of text. For a hawkish side, if they see that they're not confident in their inflation, in inflation meeting the 2% goal, that would be a bit of a surprise, because ECB members have been talking about the process, or the disinflation process, making its way towards a 2% goal. So it'll be flipping the script, and when the script is flipped, then you also get the expectations, which are flipped from the market, and you get stronger moves that occur. Ari says, can you please post a translation after the video, especially in German? I think there's an auto feature, isn't there? Does it not happen? If it doesn't happen, I'll look into it. But then I've got to do a translation for every language, and there's quite a bit. Maybe we could hire someone to do that for us. And let's look at the hawkish scenario as is there. They say that lingering upside risks like wage pressures warrant caution on inflation. Although ECB's lane has said that inflation is in a better place, more or less. Pushing against the current pricing in for a June rate cut would be very, very hawkish, considering, as said, as the markets are pricing in June to be the first rate cut. Despite what happened yesterday with CPI in the US and some of the repricing, it was a slight amount. But pushing that away to the side and being very hawkish in that stance would provide a bullish reaction to the euro from that hawkish surprise, if that were to occur. Now, you could get a mix of this here if that were to happen. Let's say where they see they're sufficiently confident that inflation target will be met, but that they're going to be data dependent and probably could push back against a June rate cut. So in that situation, with mixed comments, that makes it more difficult to decide which way you should trade if you're trading the euro. Do you buy into it? Do you short it? It's more muddled. So you're looking for a clear monetary policy statement that either is dovish or is hawkish, or has a slightly more dovish or slightly more hawkish tone to it, to give you more of an opportunity, a clearer opportunity when it comes to trading the rate statement. And that's going to take time, because you have to kind of weed through the comments and then make your choice as to which way you're going to move through. Again, it makes it more difficult to trade interest rate decisions if you're trying to jump onto the spike or in the first minute or so. So bets and expectations then on March 7th, you had traders that add to ECB rate cut bets, see 97 basis points in 2024. And then later on, they saw 100 basis points of ECB rate cuts this year. Bearing in mind, of course, that's post the last ECB interest rate decision. April 10th, post the stronger CPI data, money markets pricing around 80 basis points of rate cuts from 87. So a change, yes, a shift to smaller amount of rate cuts being a less amount of rate cuts being expected, but still not enough to really change the scenario for a June rate cut at this point. MUFG, they say that we have become more confident the ECB will begin to cut rates at their following meeting in June. They made comments on April 8th after the release of weaker than expected Eurozone inflation, and it is also fully priced in by Eurozone rate markets. Goldman Sachs, they say there has been clear pickup in interest to run core dollar length in the last 2 weeks, as the market perceives a growing hawkishness within elements of the Fed that are reducing expectations for a June start date for rate cuts, at the same time as other central banks, such as the ECB and the Bank of England, appear to be delivering a more accommodative narrative that suggests rate cuts will have begun by June at the latest. With the CPI data yesterday, the September rate cut was cemented even further for the Federal Reserve. It did slightly alter expectations for the ECB, but not enough to put off a June rate cut to happen by the ECB. Deutsche Bank, they say that the downside surprise on March core HICP wasn't large enough to think the hawks will concede to the doves and agree to a rate cut already on for today. They say that the ECB needs additional data over the next 2 months to underpin its confidence in price stability and open the door to a rate cut in June. They don't expect the ECB to pre-commit in April to cutting in June, but it should be clear that a June cut is the working assumption, barring a significant shock. And then Citi, they said on April 9th that they expect the ECB to deliver 4 25 basis point rate cuts by the year end versus 5 previously expected. So what Deutsche Bank are talking about of the ECB not pre-committing to a June rate cut is by them not explicitly ruling out a June rate cut in their statement, which will then further cement. So if they don't rule out the June rate cut in their statement, then that will of course help the doves and anyone who's bearish on the euro to further cement their expectations for June to be the first rate cut. And that might mean that not a lot happens from the euro just solely off of the back of that, unless the flip side scenario happens where the ECB do push against a June rate cut. Then you have euro strengthening that could then occur instead, and you see a more bullish reaction from the euro. Cenk Ertuk says, I'm short on franc, the CAC 40, and my trade is going up for TP. Should I close a position? You do whatever you want to do. I mean, it's totally up to you. I won't say anything on that. What else we got? What else we have here? Okay, let's carry on then. So this is the last rate decision that we had, and you can see the market reaction. If I just let it play, this is about less than 10 seconds before that market reaction occurs. We'll just sit and watch and see how it reacted beforehand. So as the rate comes out, you can see that there is hesitation as to which direction to go in. You don't see a lot of movement because traders in this scenario haven't been given a clear indication. They're taking in what the rate statement is saying. So they need to see what the rate is, read the statement, and then you see the market making its decision. Because there were no clear indicators that the ECB was very hawkish or very dovish. So I took a short on that there, closed it a little earlier before the take profit, because I could see that buying momentum coming back in. And then if I kind of skip ahead in the video, let's kind of see a further market reaction. You can see there's kind of cemented, took another little short after that there. If we look at what the ECB had said from the rate decision, if you're looking at the ranges and deviations sheet on the 7th of March, so what they said was that projections for inflation, excluding energy and food, have also been revised down, an average 2.6% for 2024, 2.1% 2025. And then off of the back of that, and the markets, then you have the repricing or the pricing of the ECB rate decision, with the ECB ESTR forwards pricing in 97 basis points of rate cuts in 2024 from 92 before the ECB statement. So it wasn't too much of a repricing that had occurred, but it was still enough to cause a market reaction, which had seen downside movements on the euro, which, to be honest, did. If I bring up the ranges and deviations sheet, we don't have too long left. Let me just kind of skip forward as well. Yeah, so it did continue to hold its momentum with the euro continuing its weakness, but it wasn't a very strong initial market reaction, enough for traders to fully reprice the interest rate decisions for the future. So let's get out of this and let's get out of that. Let's bring in the ranges and deviations sheet. Okay, let's see what we had here. All right. So here we go. If you don't have access to the ranges and deviations sheet, all you got to do is sign up to the MacroAce mailing list, which is completely free. We are looking to migrate this stuff to a web version, so it's of course easier to kind of look at the data and anything else it's easy to look at the data and any other points or notes that I make about the rate decisions or any economic releases, like I did yesterday for CPI, and how the markets had repriced their expectations for the Fed, or had solidified their expectations for September. But let's look at the market reactions. So the biggest market reaction came from the euro-yen, with about 31 pips towards the downside. So let me explain how this works, okay? So here, hopefully you can see the highlighted figure. Shows the first figure here shows you the initial market reaction going to the wick of the candle to capture the entire move. The figure in black brackets represents the move 10 minutes after the release has occurred, going to the end of that candle. This is all on a 1 minute chart, by the way. And then the figure in the blue brackets represents the move 30 minutes after the release has occurred. So you can see after 10 minutes, it was still heading lower, and then started to claw back some of its initial losses after about 30 minutes. Whereas on some of the other currency pairs, so if we're looking at the euro, New Zealand dollar, that downside momentum continued further. So that's something to bear in mind, is that with the euro yen, yes, the initial movement was stronger, but 30 minutes after the release, the movement was starting to move back towards the upside. Not by a lot, still down, but compared to Euro New Zealand dollar and Euro Aussie dollar, not as much. Looking at the Euro bunds, you can see here again, momentum continued to move towards the downside after the rate decision, more or less because of how the ECB had viewed their inflation expectations, which, to be honest, as I said, didn't provide a lot of momentum. And you can see from past market reactions that there hasn't been that much of a strong reaction to the ECB rate decision in the past, only going all the way back to July of 2022, when you had stronger moves that had occurred because of the surprise that the ECB had delivered then. But even if we're looking here, where back in 2023 in September, where there was a surprise delivered, that was, if we're looking at the sentiment at that time. So despite the rate hike, there wasn't really a big surprise, as the markets were already pricing in the bigger chance of a 25 basis point hike. So there was already the momentum. Sentiment was pricing in for a surprise rate hike to happen. So the market reaction wasn't as big as it was in the past when the ECB have surprised the markets. I said this for the Bank of Canada rate decision yesterday as well, that they have been known to surprise the markets, and they've gone against the grain completely to what the markets expect. If that happens today with the ECB, where they surprise the markets and they do decide to cut interest rates by 25 basis points today, when nobody is expecting them to, and ECB members have shot down the idea of that happening and pushing towards June, that would be a huge surprise. Nobody's pricing that in. That's the key thing. If nobody's pricing it in, the bigger the shock, the bigger the market reaction. If traders are starting to price it in, then if they do deliver a surprise 25 basis point rate cut, then yes, there may be the initial weakness, but if it's already priced in, then the market reaction might not last that long. But that's not the case today. No one's pricing in for an April rate cut. If it does happen, it'd be a surprise. You'd likely see euro weakening, unless it's paired with a very hawkish rate statement, and then it'll be a cluster, and it'll be mixed, and then it just makes it very difficult. And probably in that scenario, you might just want to jump in here and there to take mini trading opportunities, and not a sustained decline or rally in the euro. Here with the stock indexes for the DAX and the FEX, the Stocks 50, you can see that DAX has had a bigger reaction, of course, compared to the Stocks 50, but it was more sustained, and compared to what it has been in the past with rate decisions. Okay, so hopefully that makes it all clear. We've got less than a minute to go. Let's keep an eye on what the markets will do. So we're looking for the ECB to say that it's for a dovish reaction, that they see inflation sufficiently heading towards, they're sufficiently confident with inflation heading towards, that it will head towards the 2% goal. And the likely scenario is that they're not going to deliver a rate cut today. The hawkish surprise would be if they decide to say that if they decide to put off a rate cut for June, then you're going to get a mixed reaction. Guru Chef says, can I buy an euro dollar? It's up to you. I wouldn't recommend it, but it's up to you. I mean, you kind of got to wait for what the ECB has said and the rate decision. Okay, less than 3 seconds. Okay. Right, I'm going to go quiet, guys. All right, so I called the decision to short the euro. The main reason being, if I can get it back up again, the first reason, where is it? Future decisions will ensure that. No, sorry, hold on. Let me bring it back up. Where'd it go? Inflation has continued to fall, led by lower food and goods price inflation. What else? Determined to ensure that inflation returns to 2% in a timely way. Where'd it go? There we go. Key ECB interest rates are at levels that make a substantial contribution to the ongoing disinflation process. But let's see what's keeping the euro, what's caused the euro to have a bounce from the rate. Okay, there's quite a bit going on. The ECB is not pre-committing to a particular rate path, so that would be the comment then that's keeping the euro, that's allowed the euro to bounce back from the initial decline that we've seen here. What else we got here? ECB, most measures of underlying inflation are easing. No, that's not going to be it. Okay. Key points then for this bounce we'd seen from the euro is that they're not pre-committing to a particular rate path, but when talking about inflation, as saying that, I lost it again. That the key ECB interest rates are levels that are making substantial contribution to the ongoing disinflation process. Domestic price pressures are strong and are keeping service price inflation high. Okay, so does that make it clear for you guys as to why that happened? So the initial market reaction, I'll say it again. So the initial market reaction was that for the dovish reaction was that key interest rates are at levels that are making substantial contribution to the ongoing disinflation process. Inflation has continued to fall, led by lower food and goods prices inflation. Then, on the flip side of what had stopped what had led to the bounce we'd seen from the rate decision, was that they're not pre-committing to a particular rate path. So they're not putting out, they're not rejecting a June rate cut, and they've kept it ambiguous. So you see the market reaction isn't really continuing a sustained move towards the downside, and with this here at the moment, now looks boring. So you did see me take that one trade. It took me about a minute to kind of read through the rate statement and then find that opportunity. It's difficult, but luckily it worked out. So we're prepared for that. But you got a slight mix with the rate statement. Let's have a look at some of the other areas too. Or that it wasn't enough. It wasn't dovish enough for traders to say, yep, they're definitely committed to June and they see inflation headed towards the 2% goal. So that not being pre-committed kept everything in, kept the euro in check. Hopefully that makes sense. All right. So the likely scenario then for the ECB press conference then is that Lagarde is going to more or less reiterate that they're not on a pre-committed path. If she confirms that June is going to happen, you might not have that much of a you might have a little bit of euro weakening, but it's already been priced in, so not that likely, unless she decides to expand on the not pre-committing to a rate path, that she puts June to the side and says that they're not ready yet, and then that'll provide a more hawkish and bullish reaction for the euro. The DAX, let's see where the DAX did. Let's move this out the way now. Okay, we're done with this. Let's look at bonds. Yeah. Okay, euro dollar still maintaining its downside move, although it hasn't gone past this little level yet. Yeah, around there. Goes. There. All right. Euro yen is continuing to bounce back. Possibly means then for the euro dollar, you might see a further bounce back. See how that happens. But I'm going to leave it alone now. So, quick jump in opportunity on the ECB rate decision. All right. Yes, we do. There is PPI data coming out in about 6 minutes' time. We'll keep an eye out on that anyway. Actually, let me bring up my ranges and deviations sheet. As said, if you haven't subscribed to the MacroAce main list, then of course you won't have access to the ranges and deviations sheet, which is very useful to understand how markets react, or how much markets react to not only interest rate decisions, but also economic releases, like we had with US CPI yesterday, and with PPI in about 5 minutes now. Let me bring that here so we can see for today. Why not? I'll share with you guys today. with how PPI had reacted last time. Now, definitely not as big as the CPI reaction with the PPI data from what we had seen, but it did still see a decent reaction from the stock indexes. Oops. Definitely from the stock indexes, but comparing to the currency pairs, despite the higher than expected, much higher than expected data, it was mixed. Hence, I haven't done it as a report, as an economic release today for a live stream. But we might as well keep an eye on it anyway for any further price pressures. I think if you do get stronger than expected data today, then that will hurt the stock indexes even further, provide a further boost to the dollar. Unless you get weaker than expected data, then that could provide a little bit of relief to stock indexes from the hammering that they'd taken yesterday and have not recovered from since. And that usually happens. So if we're looking at CPI yesterday, look at that reaction. There we go. That was the largest reaction from the NQ since, let's go, since November of 2022. Okay, so again, the importance of the CPI release being the third release to increase, third release in a row to increase when the central bank is considering when to cut interest rates. Out the window. June is gone forever. PPI is not going to bring it back. It might not be enough. Definitely won't be enough, should I say. But it could provide some relief if you do get weaker than expected data. And usually with PPI, the biggest market reaction we've seen, or last time we'd seen, was actually from cable. The last two, actually, with 22 pips down the last time round, and then 35 or 36 pips down the one before that. Usually, it's been the dollar yen. So key ones to look out for are the dollar yen and cable for market reactions. Now, as I said, if you don't have access to this, right, and you want to get access to this, as I said, all you got to do, subscribe to the MacroAce main list, and then on Monday, you'll get the link to the deviations and ranges sheet to be able to see the make your own decision as to what you think how you think the markets could react in the future, depending on what the release is, or how the release plays out. Okay, so let's get that out of the way. Put that there. Yeah, there we go. I'll bring up the dollar yen on here. Okay. Yeah. And also, so we've got about a minute and a half, but FinancialJuice is where we get the data from for the economic releases, but also FinancialJuice, if you've never come across a live voice and text service as a day trader, it is an essential part of your day trading experience. Why? Because it keeps you informed as to what's going on within the markets, headlines that might have come out of from central bankers. We've got less than a minute left. Central bankers or that have cause a shift in expectations for rates. You may have geopolitical events that are currently going on, like we had with Iran, and the potential for them to join in with the conflict even further with their proxies, and that led to crude oil seeing a jump, a move towards the upside off the back of that. All these different things. Day traders need to be informed and stay in the know via voice and text, and you can do that with FinancialJuice. We've got about 15 seconds on the PPI data. I'm not going to trade PPI today. Just going to watch it, see how it reacts, how much of a reaction that we get, and if we do get any repricing that occurs. So we'll let that do its thing. You guys can see it on the screen there. with the data. So weaker than expected on the year-on-year. Core stronger, much stronger actually, than the prior figure too. So that might provide some moderation to the market reaction, but so far it's not doing that. What else we got? You got core PPI that's remained unchanged. Month-to-month lower, significantly lower compared to last time round. PPI year-on-year, although it was lower than expected, higher than the prior figure. So figures lower than the forecast for PPI year-on-year and month-on-month, providing the upside to the S&P, downside on the dollar. But you do have the core data that was stronger than expected. But anyways, the markets are enjoying it. But yeah, so as I said, if you want to stay in the know of what's going on within the markets and be on the bleeding edge of news, and having a live voice and text service, having FinancialJuice on your desktop or on your mobile as well. We do have the app on Android and iOS. Keeping in the know what's going on will help you have a more informed decision as to how you're going to trade and maybe manage your risk as well. So for those of you who want to get access to FinancialJuice, all you got to do is sign up to the link here. Okay. So yeah, first of all, create an account on FinancialJuice, which will bring you to the light version of FinancialJuice. The light version of FinancialJuice, it does have a delay, and it also means with that delay, you get a delay on the voice, you get a delay on the text and the economic calendar. Okay, you can see here on the left-hand side, the text in the center. The voice is off in the right there. You do also have adverts that play in the light version, but if you're new to using a live voice and text service and you never come across it before, so here we go. Like this headline that's come through with what markets are feeling, what markets are pricing in. US short-term interest rate futures rise after PPI and unemployment insurance reports. But yeah, as said, so if you want to stay in the know with what's going on, if it's your first time, coming across a live voice and text service, use the live version. Yeah, there's a little bit of a delay, but it's best to have a little play with it, get used to it, figure out what if it works for you. If it doesn't, that's fine. If it does work for you, perfect. And when you feel confident and ready, then you can sign up to the pro version of FinancialJuice. Okay. When you sign up to the pro version of FinancialJuice, of course, as I said, make sure you do have an account with your login details and you verified your account from your email. You've paid for your subscription. Then log out of FinancialJuice and log back in. And then once you've done that, you'll get the pro version of FinancialJuice. Otherwise, if you don't do that, then you'll be stuck on the live version of FinancialJuice, and then it won't be a smooth ride with what to expect. It won't be a smooth ride when you're trying to use FinancialJuice. Okay, there we go. Traders keep bets on first rate cut in September. See slightly higher chance of July after data. That's a bit surprising. Fair enough. All right. Despite the figures, it was weaker than the forecast, stronger than the prior data. Markets are still looking. Markets are creeping back in with July after that report. So see, stuff like that, keeping in the know what traders are feeling, right? You can see that, obviously you can see how the market's moving, but if you also understand the underlying sentiment, that then helps you in your decisions. If it doesn't, it doesn't. Fine, fair enough. Do your own thing. If that works for you, then great. But remember, fundamental news moves the markets, and then it's down to your technicals, and the rest is, and then it's down to whatever you want to do, however you want to play it. All right, so that's FinancialJuice. As I said, you've got the link there to sign up to FinancialJuice, the live version, and then here there'll be a button where you see where I'm clicking. There'll be a button here which says Go Pro, and then you can select your subscription and then make your payment to whichever subscription that you would like. Also, TICKSTRIKE here. TICKSTRIKE, if you've never come across it, TICKSTRIKE allows you to listen in to order flow within the markets, or another way to put it is it shows you how strong the buying or selling momentum is through these different ticker boxes that we have here. So if we're looking, well, let me bring up euro dollar. Let's bring that here. We've got it there. So this ticker box here represents the strength in the buying or selling momentum for the euro dollar. Okay, and it gives you a visual and audio alert. Is there an NQ TICKSTRIKE for pro users? Yes, there is. For pro TICKSTRIKE users, yes. Not for FJ. FJ doesn't include TICKSTRIKE in the package, the full version. But yes, there is a pro version of the NQ for TICKSTRIKE. For the NQ there is a pro version. Hold on, let me say that again. Gosh, I got my tongue tied there. On the pro version of TICKSTRIKE, yes, there is the NQ. Apologies. Yeah, let me bring it up for you. Comes up. There you go. Yeah, there you are. It's here. You've got that there. Wow, it's still going. Nice. Yes. So, as I was explaining, let's bring up the S&P. So it gives you a visual and audio alert as to the buying and selling momentum of the movement, and it has different levels of sensitivity. So it goes from 1, which is the most sensitive to market reactions. When there's a little bit of buying or selling going on, then TICKSTRIKE will give you an audio visual alert, and you can choose whether you want to do audio or visual or both. As you go higher and you go all the way to 15, note here you can chop and change the sensitivity. 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling momentum that occurs, only then will TICKSTRIKE give you an alert to what's going on. Okay. So again, if you've currently got a position, and as said, you can chop and change that to whatever sensitivity works for you. Then you can, again, manage your positions, capitalize on potential positions, potential opportunities that are available to you. Jeez, wow, the markets really did want, they really wanted the weakest PPI report. Well, but yes, as I was saying, there's another feature here, which is, so if you like to scalp the markets for those little opportunities here and there, then this lightning bolt button, okay, will give you that extra amount of sensitivity. Remember, 1 is the least sensitive. If I put this on, now we're going 15 levels below 1. So now it's uber sensitive to market reactions. So every little bit of buying or selling that goes on, I'll move the mouse away and you'll see how aggressive it is. There you go. So it's, you guys can't hear it, but I can, and I can hear I can hear the ticker for the S&P going off here and there all the time. But if you're looking to scalp the markets, then the lightning bolt version of TICKSTRIKE is made for you to use. I mean, be my guest if you want to have a little play with it. If you're not scalping the markets, have a go, see what you feel like. But that's what that tool is made for. For me, I don't scalp the markets, but I prefer without the lightning bolt. But of course, for someone who does prefer the extreme sensitivity, fine, go for it. Good. You know, have a little play with it. Do all works for you. You know, try out the product, and then we can try out for free if that's your next question. There is the delayed version on FinancialJuice. So this box here, okay, you can see this shows you is limited to the 4 assets: stock index, the S&P 500, euro, dollar, oil, and Bitcoin. It's limited, and also the sensitivity is also restricted to, I believe, is that 6? It's about halfway, I think, or just below halfway. It's restricted, but it will give, just like with the live version of FinancialJuice, it gives you a sense as to how it works, and particularly if it's the first time you've come across TICKSTRIKE before and you don't have an understanding of it, or you want to feel more comfortable and confident about it, use a free version before you decide to jump onto the pro version of TICKSTRIKE, which is with a link right here. Okay, that is a link there for the pro version of TICKSTRIKE. So with all of our products and services, there's a light version, there's a free version of it, so you guys can get used to it, understand it better. Once you have that understanding and you feel comfortable, then you guys can subscribe to the products and services that we have. And that's the best way to do it, is to give you guys the ability to play around with it. And I'm sure you guys have found it useful in the past. NJ says, worth paying for, made more than the cost with the Iran-Israel news yesterday. Presume you're talking about FJ there. Talking about Bank Japan intervention. Well, 155 is what the level on the dollar yen is. What some is what I read it this morning. Is what some analysts were saying, that is when the Bank of Japan maybe could intervene in the market. That's not 100%. But if they were to, if 155 is the level that the Bank of Japan could intervene, then well, of course they're looking to raise their interest rates maybe one more time this year, maybe a couple more times. Currently, there's 2, including the one. So the one that's already, including the one that's already happened, to the range of 0% to 1%, and then maybe another one further down the line, maybe in the summer instead. I think MUFG were talking about July as another possibility for a rate hike from the Bank of Japan, potentially. I'll have to have a little look and read through that again. But 2 rate hikes is what was currently priced in for this year. So one more hike is expected from the Bank of Japan overall. Okay, so that is TICKSTRIKE. Let me grab again for the mailing list. Let me just show you what the email would look like for you guys. So let me just close TICKSTRIKE. Get out of the way. Okay, here we go. So an email that is sent out every Monday. You get an email that looks like this. It's short. You get the links to the ranges and deviations, links to the live streams. You get a summary for each session of what to expect or what's happened in the last session, if there has been anything that has that was useful to have a look at or to understand as to what is affecting sentiment for the week ahead, or could. They're very short. Sometimes they can be a little bit bigger, but there's not a lot of information in them. Really, it's supposed to act as a refresher to what's happened in the past and what to expect for the week ahead. That's how it should be used. So, because the detail is provided within the live streams when we're covering the major economic releases for that week, within the US session, part of the European session. The European session releases would be Bank of England and ECB. I do have to cover the other releases for the European session, like UK CPI. Eurozone inflation, not so much, because the market reaction doesn't really have that much of a market reaction. It's more about pricing in what traders are feeling, or market participants are feeling. But yeah, I do need to do more work in the European area and also in Asia too, and add some of those releases into the ranges and deviations. But anyways, that should give you an example of what to expect. Also, don't forget to like the video, subscribe to the channel, get the word out there if you found the video and the information useful. And I shall see you guys next week, right? So look out for my email Monday, once a week, and I will see you guys then. Okay, have a good week, have a good weekend. Thank you very much for joining me, and see you guys next time.